There has been tremendous volatility over the last couple of weeks, more driven by what's happening globally and some domestic reasons. And it's not only India, but globally, all markets have seen excessive volatility over the last couple of days, couple of weeks. And it's driven by a couple of factors that I'll discuss a little later. But if you look at the global equity markets, the MSCI Global Equity Index at some point, a few days back, was down 10%, now it's down 7 or 8% year till date. Spreads on high yield bond index has gone up. Spreads on junk bonds or emerging market bond index has gone up. Emerging market equities are down, bonds are down. Most of the currencies have witnessed correction in the last couple of days against US dollar. We've also seen most of the commodities touching record low, so including the crude oil at $28, but most of the other commodities have also fallen quite a bit. So across the markets, we have seen not only heightened volatility, but some of the markets really seeing some kind of a panic. What's really driving the whole volatility that we have witnessed? Couple of reasons. One is, I think, the concern about the China, and it's not only about the slowdown in China, but if that also leads with the capital outflows that China is witnessing, a sharp depreciation in yuan, in the RMB, their currency, the fears about their growth, which is having an impact on the commodity prices, fears about the slowdown in the global growth, which is driving down global equities, and particularly at that time, the fears of Federal Reserve increasing interest rates in that environment. Markets are also worried about the impact that the fall in commodities market can have on all the other markets. With the fall in commodity market, most of the commodity exporters, particularly the oil exporters, their sovereign wealth fund have been a net seller in different markets. Because at $28, most of these countries will find it difficult to meet their fiscal requirements and have to draw down from their reserves. They are also putting pressure on various markets as they put redemptions in the funds that they are holding, or they sell their holdings wherever they have that. And with decreasing liquidity, it's having excessive impact on all the markets. The correlation in market has gone up with almost all the markets moving in tandem. In fact, the correlation with crude oil of all the markets has gone up substantially. And one of the reasons could be that the worries that each market has got has also to do a lot with what's happening in the crude oil market. The way commodities have fallen, the first part of it, which happened, let's say we started sometime in 2014, 2015, was good from a global macro perspective. The way China was growing between 2003 and 2008, and after the stimulus they did in 2008-9, again for a couple of years, the growth that China had boosted the commodities market. And there was a shift of money from commodity consumers to commodity producers. As China slows down, and also the huge amount of supply response that has come in most of these commodity market. For example, if we talk about the crude oil, whether it's the shale gas in US, whether it's the LNG supply which has increased globally, whether the nuclear reactors that have started in Japan adding to supply, a lot of other renewable energy sources that have impacted the demand, supply side particularly, and also the huge supply coming in from players like Iran, Russia, who have been out of OPEC. And that's why the way oil prices have fallen, and they've reached a level where it has started impacting markets, which though while one can argue that is good from the global economy perspective, good from the global macro perspective, as the money shifting from the producers to the consumers, which in the long run should be good, but in the interim, markets are worried about the earnings of the energy companies. Markets are worried what happens if there are bankruptcies in some of these energy companies, which may find it unviable to run their business at these valuations. And markets are worried that some of these countries even may have some kind of a geopolitical risk. I'm talking of countries in Middle East. And that has impacted the sentiments. And we are seeing that all markets have become quite linked to crude oil. In fact, even which actually diverged last year from the crude oil, we are seeing renewed correlation, very high correlation with the crude oil of Indian markets as well. If you put the chart of Nifty and crude oil, and you'll see how they are moving exactly in line last couple of days. We believe that some stability in the overall commodities market will actually go a long way in probably changing the sentiments that we are witnessing at this point in time. Now, historically, equity market fall of more than 10% or so has coincided with a global recession. Markets have, whenever the global equity market fell around 10%, that period coincided with a global recession or a sharp fall in global growth. If I look at the global economy today, do I get a sense that the global economy is actually heading for a recession? The global economy is actually decelerating? Not really. If you look at the unemployment data in particular, whether in US, where the labor market has been strong, whether in Europe, where the unemployment rate has been decreasing for last couple of years, even in Japan actually, the unemployment rate is at a multi-year low. The consumer sentiments have been okay. They are not as bearish or as pessimistic as the markets are telling us. The PMI, Purchasing Managers Index in Europe, has been inching up. In US, I believe the economy is chugging along well. It's not a very strong recovery, but it's not showing signs of a recession that the markets are telling us. Same thing for some of the other parts of the world. There are serious challenges for the emerging markets who are dependent on growth in China or the prices of commodities. And of course, their currencies, their bond markets, their equity markets have taken a severe hit. There are redemptions in emerging market equity and bond funds for last several weeks, putting pressure on their currencies and their markets. Any investor who is into emerging market, who's managing an emerging market equity fund, if he's got redemption, is selling Indian equities also because of the redemption that he's got, and that's impacting us. So as I mentioned that from 2014 to 15, for a good part of time, we were showing resilience thanks to the domestic money, as well as the impact of the commodity price fall was positive for us in terms of improving our macro. But last couple of days, suddenly with the heightened concerns about what could be the near-term repercussions or a tail risk that can happen from the fall in commodity prices has impacted Indian equities market also. Where do we go from here? As I mentioned that our base case scenario is not that global economy is heading for a recession. In fact, when we look at the data, whether the labor markets or whether the economic growth, we believe that the global economy is not showing signs of recession. Of course, there can be a tail risk coming in from China, who's been dealing with a property bubble, who's been dealing with a stock crash that has happened, who's been dealing with a sharp deceleration in growth rate compared to what they used to have several years back, and the capital outflows that are happening from the country. Of course, there could be pressure on currency. Lots of people are betting on very sharp depreciation in yuan, but we believe that China still has got the fiscal muscle power. They still have got the firepower in terms of policy armaments, and highly unlikely that actually we are going to see a big tail risk really playing off in China and impacting the rest of the world. There are huge worries on account of China, on account of what's happening in global economy, on account of commodities and a geopolitical risk. But we believe that markets are getting excessively worried, and these are definitely a tail risk. Tail risk meaning a possibility, a very small possibility of that happening with a large consequence. But as I mentioned, the possibility of that happening itself is very small. Our base case is that global economy is chugging along well, and I think if the while even if US Federal Reserve increases interest rates this year, most of the other central banks are likely to be on an, we will have an easing bias, and unlikely that globally we are going to see a very big challenge the way people are perceiving something like 2008, 2009 happening in 2016. Now talking about India, we are seeing a disconnect between the India's macro and India's micro. We saw a big rally in Indian equity market in 2014 as people cheered the fall in commodities market. People cheered the possibility of political stability coming in. People cheered that the overall macro situation, which we saw deteriorating in 2013, improving substantially. So whether it's the current account deficit, whether the fiscal deficit, the high inflation that we had, interest rate cycle turned positive with RBI having RBI announcing interest rate cuts in like 2015, 16. And I think all these macro improvements, the substantial increase in foreign exchange reserves, the stable currency. All these improvements on the macro side were also expected to, over a period of time, reflect at a micro level, which means corporate profitability improving substantially. But in calendar year 2015, we did not see that, and that has impacted our market to some extent. Over the last couple of quarters, we have actually seen earnings downgrade almost every single quarter. The three or four reasons which have impacted our micro situation compared to the improvement that we have seen in macro would be, I think some of the reasons which have resulted in improvement in India's macro situation are also responsible for what's happening at the micro level. Let me explain that. The one is the fiscal consolidation that the government is doing. If the government is spending less money, if the government is consuming less, if minimum support prices have not been increased to contain the food subsidy, or if the government is doing a direct benefit transfer and controlling the subsidy bill, that's also impacting the consumption. There is less buying power in rural India, particularly with less increase in MSP, two successive droughts, and less government spending. So fiscal consolidation is good from a macro perspective, but in the near term, it's impacting the rural demand. If you look at the positive real rates that we have moved to, when we had CPI at 9 or 10% and rates were 7 or 8%, now we have a situation where the nominal GDP itself is growing at 8, less than 8%, and we have interest rates higher than that. The bank deposit and lending rates are higher than that. And that's impacting the corporate's ability to increase their top line. The revenue growth would always be impacted by what's happening in the nominal GDP. For last 10 years or so, barring few quarters during the 2008-9 slowdown, India never had nominal GDP growth in single digit. So some kind of a deflationary environment that we have seen, the fall in commodity prices, the fall in overall prices has also impacted the corporate's ability to grow their top line. The slowdown in global growth is impacting us. If the global trade itself is not growing at the pace at which it was growing, our exports have also taken a hit. We were all very happy that global commodity prices have come off. India is going to save so much from the crude oil. But the fact is, with the global slowdown, our exports have also taken a hit. And last but not least, I think the stress in some of the balance sheets in the real estate sector, some of the corporate balance sheets, which in turn impacting the banking sector balance sheet. I think these are some of the reasons which are impacting the overall corporate profitability growth. But our sense is, as we move beyond March 16, I think the base that will get created for corporate profitability will be such that on that base, as some of these things unwind, as some of these pressures unwind, as the cyclical recovery takes place, as government spending improves, particularly on infrastructure, that also impacts the rural demand. And hopefully, if we have a better monsoon next year, rural demand improves. With the impact of 7th Pay Commission, one rank, one pension, and with the overall economic recovery, urban consumption is already showing signs of improvement. And with all these, we expect as the economic recovery, along with the economic recovery, we are also going to see sustained improvement in corporate profitability. In last couple of years, corporate profit growth has been much lower than the corporate profit growth for last 10 or 15 years. So as we mean revert, as we go back to our long-term growth rate in line with the nominal GDP growth, as the nominal GDP growth itself improves to double digit next year, we can expect a double digit, let's say 12 to 15% improvement in corporate profitability. With the valuations remaining where they are, even without expecting a further PE re-rating, I think markets can deliver high double-digit returns in next 1 to 2 years. The structural long-term story of India in terms of the impact of demographics, in terms of the opportunities in infrastructure, in terms of opportunities in outsourcing, in terms of having a wide variety of companies to choose from a stock picker's perspective and generate alpha, that remains intact. I think the near-term challenges that we have seen in last couple of quarters and also the heightened global volatility that we have seen in last couple of weeks are giving a good opportunity for every investor to enter the equity market and build a portfolio from a long-term perspective. as we have witnessed in last 15-18 months, where domestic investors have shown huge confidence in the equity market. But looking at the overall savings pool, and I also expect an increase in savings rate and a larger part of those savings coming into the financial savings, both in the equity and the long-term bond market, I think over a period of time, the vulnerability that we have from the global events and from what's happening in rest of the world and through the capital channel because of the FIIs outflows or inflows, an outsized impact that happens in our market will gradually recede as more money is in the hands of the domestic institutional investors. We have already seen in last couple of months where the domestic institutional investors were able to counterbalance the outflows from the foreign investors. But I think over a period of time, that trend is likely to gather more momentum. So just to summarize, I think the global volatility has witnessed a huge increase. As I mentioned that our base case is that the global economy is not heading for a recession. We expect a stability to return in some time. We think that while the Fed can still increase interest rates in the next couple of quarters, while the most of the other central banks like the European central banks, the BOJ, the Bank of Japan action that you would have heard last week, I think most of the other central banks remain accommodative. We believe that with the transformation that's happening in China from a manufacturing and export-led growth to a more consumer-led and more services-led growth, I think over a period of time as the economy stabilizes or some kind of a soft landing that we expect, I think is likely to stabilize even the commodities market, which are at the epicenter of the crisis that we are witnessing at this point in time. And with that stability returning, we expect that Indian markets will also return back to the strong domestic macro recovery over a longer period, and at a micro level, corporate profitability returning, and with valuations where they are, and with the liquidity flows one can expect from the domestic investors, we think that markets can deliver decent returns. What we have done in our portfolio over the last couple of years, we had a bias towards quality stocks, particularly avoiding the companies with high financial leverage and also the lenders who have exposure to these leveraged names, and also avoiding some of the companies that may get impacted by what's happening in the global commodities market. That has kept us in good stead. Even going forward, we believe that a focus on bottom-up research, a focus on bottom-up stock selection is the best way to generate alpha. And the way we have generated alpha in most of our equity funds for the last couple of years, we believe with our focus on fundamental research, we'll be able to generate that. Maybe I'll say a goodbye to the people who have joined us on Google Hangout, while most of the other investors who have joined us on the dial-in, we can take some questions from them.
Yeah, Harpreet, can we open the line for the Q&A?
Thank you, sir. For a Q&A interactive session.